Hey, welcome to the Compassionate Capitalist Show. It's Karen Rands here, and I'm running solo. I am doing this podcast or this recording really for the investors in the audience because, we've done a lot to discuss how best practices for growing companies to reach or exit. But one of the things that I offer as part of the services and what I did for really many, many years when I ran the Angel Investor Group, the network of business angels and investors. And when I had built that up to be one of the most active in the US and definitely the most active in the Southeast, part of the services that I offered that made the organization so successful was due diligence services and screening companies to eliminate the red flags of those companies that might have risks associated with them that you may not think about. So many times investors consider the sizzle of an investment opportunity. They look at the opportunity, the market opportunity, the novelty of the invention, and the impact it could have, the potential demand in the marketplace. And those are all necessary for making a decision about an investment. But when it comes down to deciding whether this particular company or that particular company, or should you move forward with this company, there are things that you can look for that quite frankly, I kind of had taken it for granted because I have done this so much in the past and have really protected the investors that I worked with from not making, I call them, like, and you hear sometimes in the conclusion, or depending on how long you've been watching this, I modified it a little bit, but I had a phrase that said, how to avoid the deals that suck, right? Well, in reality, there's a reason, there's a certain element to this metrics of that venture capitalists sort of established and investor groups have adopted, and that's that out of 10 investments, you're going to have 3 that fail, 3 that just do so, 2 that do really well and make you some money, and then 1 or 2 that hit it out of the park that make up for all the other ones. And if the venture capitalists that have all the money and all the resources can't figure that out, then what is it? And it's not just, there's a lot of factors that go into it, and a lot of them are market dynamics that are impossible to predict. But there's 2 things, and one of which we're going to talk about today. So the first one thing that we're not going to talk about today is, does that company, I talk about in my book, when you're the inside secrets to angel investing, for those that are watching. And those that have ever heard this before, I talk about my book all the time because it is the best-selling primer for how to get started investing in entrepreneurs and, minimizing and reducing the risk associated with it, much in the way that you go about deciding to invest in real estate and how you go about deciding what properties do you buy based on the potential return on investment, and what do you need as a team to help you make those decisions, or how do you co-invest with others, and what is the process? So that's all in the book, right? And so one of the things that we talk about in the book is the ability for the company to raise all the capital that they need. Because 90% of the time, quite frankly, maybe even more, companies that raise the first round of capital that from angel investors or friends and families, or this seed round, it should get them to the point of creating profit. But creating profit that covers your expenses is different than the capital needed to scale in order to become the big company making millions and millions and millions and millions and millions of dollars that's going to exit at the kind of return on investment that angel investors and venture capitalists expect. And a lot of companies don't receive additional capital from their follow-on capital from venture capital. Separate topic. I have solved that problem for entrepreneurs and investors that have those kind of companies in their portfolio. But the purpose of today is what can you do? What can you ask, what can you look into about the entrepreneur when you're making that initial seed investment that would be an indicator of their character and their ability to actually get to market, raise this initial round, and do the things with the money that they need to do in order to get to the milestones, to get to the key performance indicators that you as the investor are expecting based on what they have presented to you in their business plan and in their presentation, their pitch deck, right? So what is that? First of all, you need to take time, probably even, entrepreneurs really, really want your money fast. And you are obligated to make a decision. Like if you can get to a no really fast, you need to communicate that to them as soon as possible so you get off the fence into the no category and they can move on and clear the decks when they're building their funnel. They have to have a funnel where they're talking to, in traditional means, 15 times the number of investors that they're going to need to close, right? I talk about that in the book, The Cougaran Theory of Private Equity, and the formula that says if you're raising $1 million and your average investor is putting $25,000 in, then you need to have 40 check writers. But to get to 40 check writers, you have to have an order-to of 3x. So 120 investors that are seriously looking at the documents, asking questions, moving forward to decide yes or no. And then out of that, there's going to be an order of 5x. So a total of if you go 5 times 600, have to see the business plan, see the pitch, look at an executive summary to say yes, no, maybe give me more information, or no, not for me. And the company has to have a plan for that. So the first point is, do they have a plan for raising all of their seed capital that they need to get the product to market and in customers' hands and generating revenue and get to a point of cash flow positive? That's how much money they need to be raising. So the second point is, are they raising enough money? You need to look at their financials. They need to have really good financials that are anticipating what their costs are going to be, what that growth factor is going to be, what the time it's going to take to get that product fully developed. And sometimes products don't work when they first come out of the chute. They need iterations to be exactly what the customer wants. Do they have enough capital in their plan, their use of funds, and what they're asking for to get to that point? Because if they have not gotten, they may, in some cases, do a very small round that's just to get the product confirmed into market. And that's with the most favorable of investors that believe in these entrepreneurs versus business angels in the business of investing, because most angel groups and most business angels want to have a fully developed product with a known marketplace that is going to buy it when they come in and put their capital in. Okay, so a company can either be raising it in tranches that says they're going to, so how they raise their money, can they raise all the money, how much money do they need, can they raise all the money, and how are they going to raise it? So they have a escrow amount. This is what the minimum they need in order to get the product fully developed and market tested. And then they continue to raise the capital that's going to be the commercialization of the product and get it to market. Okay. The third thing is, you need to be able to know that they will communicate with you on a timely basis. One of the worst things that I've seen happen with companies over the years is when the entrepreneurs, because they kind of feel that in some cases, with not investors that are on the fence, that they're a no, right? But good entrepreneurs that know the art of raising capital know that a lot of times those investors that are sitting on the fence and they may have pitched a month ago or 2 months ago are still potential yeses. They're just waiting for the information that they need to feel comfortable that that company has the ability to move to the next level. And so that company should be updating non-investors that are still considering it, as well as existing investors. The tone and the messaging, confidentiality may be different between the two of them, but they should have a normal scheduled update. Ideally, when they're raising capital, it should be every 2 weeks, and they are communicating out how many pitches they've done, how many investor meetings they've had, how many investors they've grown in their pool of potential investors, any milestones they've accomplished. Did they get any kind of patent response? Have they moved from a provisional patent to a patent, an actual patent? Have they developed any additional prototypes? Have they developed a 3D rendering? Have they done a 3D printer of the product? Do they have a beta test of their software? Where are they in the process of bringing that product to market? They should be communicating that to you. And if there's any open switches, do they have new advisors on their board? Have they brought new team members in their company? What have they done that indicates that they're moving forward in the business and setting themselves up for success? And are they communicating with you on the regular basis? Because if they don't communicate when they're seeking your capital, they will not communicate once they have your capital. And you don't even know, when I was running the angel group, how many times I would have investors call me and say, have you heard from this company? Have you heard from that company? And I'd contact the company, and the companies that knew that maintained really good communications really did well when it came to raising capital. They would move their investors through their funnel and turn them into yeses. And when they needed to go back for follow-on capital, there was very little dispute of those existing investors to invest more to maintain their current share and not be diluted as other investors came on, because they believed that an entrepreneur had the business savvy and communication and organization skills, time management skills, to be able to communicate them on a regular basis. When you ask for documents, is the company, the entrepreneur, the founder, organized in such a way that they can provide those documents to you without having to scramble around and spend weeks trying to get it? This is what they should, when they're preparing to go raise capital, they should have a due diligence folder, binder. I would tell companies, because, back in the day when you would have investors come to your boardroom and meet, they would want to see the due diligence materials. Now, not all investors are going to go through all that. Most investors don't, but they want to know that it exists. They want to know that you have a marketing strategy. They want to know that you are going to build this website or this thing, and this is what it's going to cost when you have the money to do that. They want to know that you're going to have an interim CFO, and this is what the fees are. So as the entrepreneur is working that stuff out, getting quotes, getting bids, finding out and confirming up their numbers, they have an estimate in their financial plan of what those fees are going to be. But as they get, as they're initially, because they don't know everything from the get-go, but they learn that stuff as they move through the process. And will they be able to provide that information? Are they developing that and sending that out in information as an update and updating their financials accordingly with that? They should be anticipating raising more money than they need, so there is movement within there without having to change their structure of their offering documents, and without having to go out and get another round before they generated revenue, because the odds of being able, unless it's just really some deep tech, the odds of them being able to raise another round when they haven't done what they said they were going to do with this round will be extremely difficult. All right. And, I always recommend that they create an investor portal. They provide secure access to it, so those investors that have expressed an interest in it that are willing to go beyond the public information of an executive summary, a pitch deck, and whatever business plan that they provide. And they want to get into more of the details of that, the offering document, some of the due diligence materials, which may be their contracts, maybe their validation, their accounting numbers, their accounting firms, validation of their numbers. They should have a portal so they can give you access, and you can get access to all the information that are in their due diligence. Do they have industry reports? Do they have analyst documents? Have they done competitive analysis? That information should be available in their due diligence portal or in their due diligence binder. But since we don't really live in a paper age, if you have it on your portal, it is the same. It just needs to be organized well. And when they have if they have a hard time closing investors as they're moving through this process, that's an indicator that their business is vague and their goal is fuzzy, that their investor relations campaign, they don't really understand how to message and communicate it. Sometimes it's just the nature of the entrepreneur. They're a technical entrepreneur, so they don't know how to talk the marketing language or the investor language. I coach entrepreneurs on how to be better at that, but there's lots of programs where they can go through an incubator. If you really love a particular entrepreneur, you've seen their pitch and they're missing it, you don't necessarily say no. I can call, you can engage me to review their documents. If you have 2 or 3 companies that you're kind of looking at and you're not really sure which one are the ones you want to move forward, well, don't waste time or make a foolish investment when you can, hire me. I have a very simple turnkey 11-point process that I take a company through, that I produce a report that will identify the things that they need to do and the risk factors associated with that particular company and what you may want to require them to do before they get your funds, right? It's easy to kind of set that stuff up depending on where they are in the campaign, how much they've already raised, what the structure of their documents are. Those kind of things are mitigating factors of how much influence you may have in their particular deal. But if they have a weak team that doesn't have the proper experience to develop their documents and articulate their go-to-market, that is a big red flag. If the entrepreneur founder is arrogant and not willing to be coached, not willing to identify the things they don't know that they don't know, and get a team in place to help them with that may be as advisors, because they're not going to have money to pay them when they're first starting out. When you're dealing with companies that are going through a Reg D5, a Reg D 506B, which is for accredited investors crowdfunding on a national basis, or a Reg A plus, they're going to have a certain level of real documents, almost like a public company. The transparency needs to be really, really apparent of their disclosure of this information and the availability of this information, because they're going to be raising capital from people they've never met before. And so they don't have the ability to influence them with their personality and their charisma to convince people to come in. You think about a lot of the unicorns that failed, those entrepreneurs had a lot of charisma and a lot of ability to attract capital, but they didn't have organization, they didn't have discipline, they didn't have fiscal responsibility. The background checks that you should run on the investors, they should have all their background checks available, part of the due diligence, so you don't have to run those. You can pull up, have they had any kind of criminal background? Have they had any violations of securities that would make them a bad actor? Do they have people on their team? Anybody that's responsible for the financials should have that kind of background check. There are some very specific things that you need to be able to have access to as an investor in their due diligence documents. And if it takes 3 months to get comfortable with that stuff, that's okay. But just be real clear. where you are in the process with that entrepreneur so that they know that you're moving forward, you're getting more comfortable, or you're getting less comfortable. And if it's clear that this is not going to be a deal that you're going to do because you have other deals that you like better, then you just need to be real clear with that entrepreneur and get them off the list. The entrepreneur should have a spreadsheet. I do this when I'm working with companies and I'm helping them raise capital. What are the conversations? What's the status of every investor? And what is the no? Why did they say no? Not my time, not now, not my deal. You're too early, you're too far along, you're whatever the situation is, and they're tracking that stuff. Because if they're going to have 600 people that they've exposed this to, and then talking to 120 at some point in time, they should have a running spreadsheet so they can keep track of it and circle back around and make sure that they're communicating. When we would do the syndication of entrepreneurs that pitched at our investor events with the NBNI, the precursor to the National Network of Angel Investors that I run now, the Network of Business Angels and Investors, we would provide that information to the other angel investor groups, and we would, have them structured to have a follow-up after they pitched of whatever questions those investors came up with that they shared with all the other investors. These are questions that other investors have had. They share it with them so that you gain a commitment and a growing consensus of this funnel of investors that there are others that are looking to invest, thus mitigating the risk and the ability for them to raise all the capital that they need for that initial round, and all the capital that they need if they're going to do it. If they're one of those companies that's in an angel group's portfolio that's in those 3 to 4, the 30 to 40% of most angel groups deals that are kind of stuck and just growing organically, they have the ability to go out and raise new capital under the new provisions for direct public solicitation, for a direct public offering. They have to really have all of their documents and the communication means pinned down and tightened, buttoned up and ready to go. And you can be an investor that helps them go to that to protect your investment and make it scale to where it needs so you can get your exit. You just have to understand that these are the key elements. If you're an entrepreneur listening right now, these are the key elements that you must also be doing in order to secure that investment from those investors as a startup or as an emerging growth company or as a growth company looking to scale. Hope you found this beneficial. Please go to cougarand.com to learn more about the services that we offer to entrepreneurs and investors, because our whole game is about creating wealth through successful entrepreneurship as that founder or the investors in that company. The greatest source of wealth is to be the founder of a successful company. The next greatest source of wealth that has been the secret of the rich for decades is being an investor in those successful companies. So welcome to the Compassionate Capitalist Movement. Thank you very much. I hope you enjoyed this particular segment. And please go out there and share this podcast and share what we're trying to do here with those around you, because without you, we don't grow the Compassionate Capitalist Movement, and we don't get more money in the marketplace for entrepreneurs, whether they're that entrepreneur around the corner or the entrepreneur that's sailing to the moon. Onwards and upwards. Have a great day.